Hello there, everybody. This is Cindy. I'm with the NRCS office and I'm the outreach coordinator. But let's just give it a few minutes before we get started and hope some more people log on. I guess we should just get started because one good thing is that this will be recorded and is being recorded right now. And that way we can watch this at a later date and it will be posted both on NRCS and FSA's website. Um, And at the end of the call, if there is any other questions that you may have for other agencies like RD, Rural Development, Amy is online, plus myself, we'll be happy to answer. But right now, we're going to get started um, and start with Angie. She's going to take over, introduce themselves, and be sharing her slide.
Good afternoon, everybody. Let me get my slides going in Teams here. And then we'll get started. Okay. So I'm Angie Steyert. I'm part of the Risk Management Agency for the USDA. I'm a risk management specialist, and I work in the Topeka Regional Office. We'll put a disclaimer here. The presentation highlights features of the Risk Management Agency programs and is not intended to be comprehensive. The information presented neither modifies nor replaces terms and conditions of RMA policies or county actuarial documents. My agenda for today, we're going to talk about a little bit about the Topeka Regional Office, some basics in crop insurance, beginning farmer and rancher, a few of the insurance plans that we have available, revenue versus yield protection, a little bit about subsidies, whole farm revenue and micro farm protection, crops that are covered in Colorado, and some crop insurance tools that are available to you guys online that can help you manage your risks. The Risk Management Agency was created in 1996 and serves America's agriculture producers through effective market-based risk management tools to strengthen the economic stability of agricultural producers and rural communities. RMA is committed to increasing the availability and effectiveness of federal crop insurance as a risk management tool. RMA manages the Federal Crop Insurance Corporation, FCIS, to provide innovative crop insurance products to America's farmers and ranchers. Approved insurance providers sell and service federal crop insurance policies in every state and Puerto Rico through the public-private partnership with RMA. RMA backs the AIPs who share the risks associated with catastrophic losses due to major weather events. In this slide, we see the Risk Management Agency organization chart along with the staff within the Topeka Regional Office and their areas of responsibility. We break out our responsibilities by state and county. In general, most specialists have counties in a couple of states. Myself, I have Eastern Nebraska. Tyler, who's going to talk to you about some livestock programs, he has parts of Colorado and parts of Nebraska. We have Dave Shep that covers Colorado and Kansas. Mitchell Stringer has Missouri. Sarah Falk, Kansas. Patrick Laird, Missouri. And Derek Johnson has the middle portion of Nebraska. On this slide, we have 10 regional offices. Our office services Colorado, Kansas, Missouri, and Nebraska. Some of the functions we have within our regional office are customer service type things, program analysts and support, underwriting, and policy participation. Here we can see the crop insurance cycle. We start off with insurance offer, or the application, I apologize. Application, sales closing, and cancellation dates, acceptance, insurance attaches, acreage report, summary, premium billing, notice of damage, inspection, claims, indemnity, contract change date, change options, and renewal. And that just keeps going. The insurance cycle just continues. Renewals, it's just, yeah. So our next slide shows what kind of losses are generally covered. Things, adverse weather, heat, drought, hail, fire, insects, disease, wildlife, earthquake, volcano eruptions, and failure of irrigation supplies. Losses that are not covered include negligence, wrongdoing, poor management and farming practices, failure or breakdown of irrigation equipment or facilities, and chemical drift. We do really require records when we're working with producers, and every type of insurance will need some kind of records in order to gain insurance. So the types of records an insured needs to keep can vary depending on the type of crop, the reason they are needed. Pretty much we want you to keep production separated by field or block, keep hard copy records, scale tickets, receipts, anything like that, and use correct unit of measure required by the crop policy, whether it be bushels, pounds, tons, however it's supposed to be. Now we'll go into the beginning farmer and rancher. Let's see. To be a beginning farmer rancher for crop insurance purposes, an individual must have actively operated and managed a farm or ranch, must not have actively operated and managed a farm or ranch in any county, in any state, with an insurable interest in crop or livestock as an owner, operator, landlord, tenant, or sharecropper for more than 5 crop years. For more than 10 crop years if you're looking at a whole farm revenue policy, excluding any crop year that the beginning farmer and rancher was under the age of 18 in post-secondary studies or active duty in the U.S. military. You can find that in the General Standards Handbook, Part 3, subparagraph 301. Beginning farmer and rancher is only for individual with exception of entities that all the SBI holders of the entity qualify for beginning farmer and rancher. Our first example is an individual married policy and is eligible for beginning farmer rancher benefits if both spouses qualify as beginning farmer and ranchers. Our second example, insured is a corporation whose only SBI is an individual who produced corn and raised livestock for 2 crop years qualifies as a beginning farmer and rancher. The corporation is eligible for beginning farmer and ranchers benefits until the individual is no longer qualifies as a beginning farmer rancher, or the corporation gains other SBIs who are not beginning farmer. We're going to talk about an insurable interest now. Insurable interest in any crop or livestock includes any interest as an individual or as an SBI holder in another person who has an insured interest in any crop or livestock, and may exclude any crop years insurable interest earned as indicated in subparagraph C, which we talked about earlier. Insurable interest exists regardless of whether such crop or livestock was insurable, or whether the person had participated in a USDA program. Insurable annual crops are the same as the crop year as the insurance policy. Uninsurable crops, the crop year is the period when the crop is normally grown, regardless if it's grown. Insurable perennial crops. The crop has reached production minimums or insurable age. Uninsurable crop is when a tree, vine, bush produces a crop that is of such value to be a commodity harvested or marketed for the area as determined by local experts. Insurable livestock is a crop year as in the insurance policy, regardless of if the livestock is insured. Uninsurable livestock is the crop year is the 12-month period beginning July 1st and ending the following June 30th. There are several examples of this in the General Standards Handbook. Insured may exclude crop years if the insured was under the age of 18. This includes the crop year which they turned 18. If the insured was full-time duty in active military service for the United States, or was the spouse of an individual who in full-time duty in active military service. This does not include members of the reserve component. This does include members of the reserve component serving on active duty, but does not include National Guard duty unless it is qualifying duty during a war or other military operation or national emergency. National Guard would have to be on active orders for authorized by the President, Secretary of Defense, or Governor for more than 30 consecutive days in connection with war, military operation, or national emergency declared by the President and supported by the federal funds. The spouse exclusion only applies to the SBI of individual person types that require spousal reporting. Post-secondary education programs. This includes academic, vocational, and continuing professional education. This does not include vocational classes taken for personal pleasure or hobby, or programs such as GEDs. For the crop year to be excluded, the insured must have been enrolled as a student for at least one semester, at least 4 months of the crop year, and cannot exceed 5 crop years of post-secondary education. An individual may choose not to exclude crop years that are eligible. Example, the individual farmed while attending college classes chooses not to exclude that crop year, though it qualifies. They could still receive beginning farmer and rancher benefits if they qualify as a beginning farmer and rancher. Again, there are several examples of this in the General Standards Handbook for reference. Beginning farmer and rancher is for individuals and is on a nationwide basis. If crops or livestock are produced anywhere in the United States that the insured has an insurable interest in, that he or she doesn't have an exclusion from it, it counts towards the beginning farmer and rancher status. The insured can qualify for beginning farmer and rancher and new producer at the same time. Also, if the insured ends up not qualifying under BFR because they have produced elsewhere in the state or country, they may qualify for new producer. If it is a new crop county, they are producing it. Make sure to consult the new producer procedures in the crop insurance handbook on this and talk to your insurance agent. After 5 crop years of insurable interest in any crop or livestock, 10 years for whole farm, the producer is no longer eligible for beginning farmer rancher benefits. Once the insured qualifies and elects BFR, it is continuous until they have actively operated and or managed a farm or ranch for more than 5 crop years, including being an SBI, exhausted all 5 crop years of BFR benefits, or canceled the BFR application. We're going to look at some insurance plans now. Yield. Our first one would be yield protection, and yield protection plans are the oldest and most widely available crop insurance product. Actuarial production history, or APH, and yield protection policies protect farmers against yield losses due to natural causes, the ones that we went over this earlier in the slide presentation. APH and yield protection products differ only on the basis that yield protection policies use futures contracts to determine projected prices, while APH policies do not. Revenue protection provides protection against a farmer's gross revenue, price times yield, falling below some guaranteed level. Guaranteed revenue is equal to the farmer's elected coverage level, 50% to 85%. At the time, the APH yield times the APH yield times the higher of the base market price, which is an average of harvest times future price for a month prior to planting, or B, the month-long harvest market price for the last month of the contract. Oh, no, that one's not showing up. Can you guys see the table that's on slide 17? Oh, there we go. Oops. Didn't realize it went on there like that. So as you can see on this slide, I've compared the yield protection versus the revenue protection. This is an older example, so the prices and the yields could be higher or lower than what is seen here. These charts are the same, except for yield protection has projected price and revenue protection has harvest price. Revenue protection uses the Chicago Mercantile Exchange Group futures markets prices and your APH yields to compute your revenue coverage and guarantee. A projected price is determined during February by using the monthly average new crop futures prices. For corn is for corn it's December futures contract, and for soybeans it's November's futures contracts. A harvest price is determined by averaging the new crop futures prices during October for both corn and soybeans. The final revenue guarantee is completed by multiplying the higher of either of the projected price or the harvest market price by the APH yield for your farm by your chosen coverage level. Again, that's 50% to 85%, depending on what you choose. Your actual revenue for insurance purposes is computed by multiplying your actual yield by the harvest price. You will receive an indemnity payment if your actual revenue falls below your revenue guarantee. The payment is equal to the difference. Here's how some of those items in our example are calculated. So projected price for corn is the average of the December Chicago Mercantile Exchange Group futures contract price during February. And then for soybeans, it's the November futures price. The harvest price would be the average of December's Chicago Mercantile Exchange Group futures contract price during October, and same with soybeans. The revenue guarantee is the higher of projected price or harvest price times APH yield times chosen coverage level. Actual revenue would be the actual harvested yield times harvest price, and the indemnity payment would be the amount by which the revenue guarantee exceeds the actual revenue, if any. APH insures producers against yield losses due to natural causes. The producer selects the amount of average yield to insure from 50 to 75%, and the producer also selects the percent of the predicted price to insure between 55 and 100% of the crop price established annually by RMA. If the harvested plus any appraised production is less than the yield insured, the producer is paid an indemnity based on the difference. Indemnities are calculated by multiplying this difference by the insured percentage of the price selected when the crop insurance was purchased and by the insured share. Revenue protection, the producer selects the amount of average yield he or she wishes to insure from 50 to 75%. The projected price and harvest price are 100% of the amounts determined in accordance with the commodity exchange price provisions and are based on a daily settlement prices for certain futures contracts. The amount of the insurance protection is based on a greater of the projected price or the harvest price. If the harvested plus any appraised production multiplied by the harvest price is less than the amount of insurance protection, the producer is paid an indemnity based on the difference. For yield protection, insureds insures producers in the same manner as APH policies, except projected price is used to determine insurance coverage. The projected price is determined in accordance with the commodity exchange price provisions and is based on daily settlement prices for certain future contracts. The producer selects the percentage of the projected price he or she wants to insure between 55 and 100%. Area risk protection, or RB, provides coverage based on the experience of an entire area, generally a county. It also provides protection against widespread loss of revenue or widespread loss of yield in a county. Individual farm revenues and yields are not considered under RB, and it is possible that your individual farm may experience reduced revenue or reduced yield and not receive an indemnity under RB. CAT coverage provides the lowest level of coverage on yield losses at a low cost to producers. It pays indemnities at a rate of 55% of the established prices of the commodity when the farm yield losses are more than 50%. Producers must pay an administrative fee for each crop insured, but RMA pays the premiums. Subsidies. The original intent of U.S. farm subsidies was to provide an economic stability to farmers during the Great Depression and ensure a steady domestic food supply for Americans. Subsidies can change with the new Farm Bill and what is written into it that the government will help subsidize for the next 5 years. You can see on the chart here the coverage level and the premium subsidy. Check with your insurance agents as to which crops have subsidies. They'll know. Let's see. This is an example of how they apply a premium subsidy. This is a very simple example. We use $100, which is the base premium. We times that by 0.55 subsidy rate, and your premium subsidy would be $55. The premium subsidy of $55 is then applied toward the base premium of $100. $100 base premium minus the $55 subsidy would be a $45 producer premium. Now we'll talk a little bit about whole farm revenue. Whole farm revenue protection and microfarm, actually. Whole farm revenue was first offered in 2015 to provide coverage for all crops under one crop insurance policy for diversified producers. Whole farm is the basis of the microfarm policy, and microfarm was first offered in 2022. It is a streamlined version of whole farm, specifically for smaller producers. These options both utilize tax returns and expected revenue to determine insured revenue, and the rules are very similar. This slide shows some of the differences between the two. Post-production costs. Post-production costs that do not qualify as market readiness operations, minimal on farm, in field, or close proximity post close proximity to the field must be adjusted out of the commodities revenue. This is because these costs are not at risk from a commodity production point of view and are not allowed to be covered under the Federal Crop Insurance Act. Leaving market readiness costs in the insured revenue was a change provided by the 2014 crop bill to help make whole farm insurance more convenient and simpler for producers growing specialty crops for specialty markets. So the biggest difference is whole farm revenue covers up to $17 million of revenue, whereas micro farm covers $350,000 in the initial year of insurance and up to $400,000 for carryover policies. In certain cases, such as veteran or beginning farmer or rancher, tribal entities, and farms which have experienced events preventing farming in a single year, less than 5 years of tax history are accepted. Whole farm history period will be different due to the tax year and lag year definitions. Early and late fiscal year filers were redefined for the 2018 policy year. And here, this slide shows within our office how many whole farm policy revenue protection policies were written over the years, and Colorado has the most in our region. The next slide shows the types of coverage and crops that are available in Colorado. Not every crop is available in every county, so please check with the actuarial information browser to see if the crop is available in your county. And dry beans say that they have revenue protection and yield protection on them when you look at the AIB, but only Pintos and Great Northerns have the revenue protection plan for them, and that's dependent on county as well. So now we'll go over some of the tools that are available for you to look at, one of them being the actuarial information browser. This is an example of how to find what kind of programs are available in a county. So I'm using Kit Carson County in Colorado as my example here. The link to the actuarial information browser is at the bottom of the slide. You can arrange the fields within the search by using the numbers next to the input fields. I've arranged this one so the state and the county are the second place of the search, and the commodity is in the fourth position. As you can see from this search, available programs within Kit Carson, Colorado are annual forage, apiculture, barley, corn, dry beans, grain sorghum, hemp, microfarm, millet, oats, pasture, rangeland and forage, popcorn, soybeans, sunflower, triticale, weaned calves, wheat, and whole farm revenue protection. This is our agent locator website, and if you don't already have an agent and you need to find an agent, this is where you can go and look. It allows you to put in your city, state, and it will show you the agents near you that provide crop insurance. We also have a new searchable directory for whole farm revenue protection and microfarm agents that deal with those. And you can go to that website right there that's linked, and you can search in that to see if there's one around you that you can talk to. The last one that I'm going to show you is the cost estimator. And the cost estimator allows you to compare plans of insurance or it gives you a personalized estimate. You will need to know the commodity year insurance plan you are wanting to use, as well as the state and county you are farming in. Then it will want you to put the plan of insurance you want and the crop you are looking at. And you could add more than one crop to this personalized estimate. It will give you a report like the one on the right side of the screen, where you'll have more options that you can select, and you will have to put in information like acres, yields, shares in order to move forward and receive your estimate. And the next slide, I show an example of an estimate and what it looks like when you're done. In my example, I put in corn and soybeans, both irrigated, looking at revenue protection for 80 acres. Insured percent is 1, and approved yield is of 100, and optional units. And this is what it came out with. The more accurate you can be in putting in your information into this cost estimator, the more accurate it will be on your estimate. It's a really good tool. And that's all I have for today. If you have any questions, please let me know. And if not, we can move over to Tyler.
Thanks, Angie. Let me pull up my slides here. Okay. Can you see my title slide?
Yes.
Okay, great. My name's Tyler Tinbrink, and I started with RMA back in 2020. I cover most of the state of Colorado, and the Nebraska Panhandle is my area that I work in. Today, I'll talk a little bit about the livestock programs, and we will get started. So what's available for livestock producers? We have the dairy revenue protection to ensure milk. We also have the livestock gross margin for cattle. That also applies to dairy and swine. And then we have LRP, which is the livestock risk protection. And that applies to fed cattle, feeder cattle, and swine. And then we also have a new program this year called the wean calf risk protection. So I'll touch on that a little bit at the end. That's new for 2024. The dairy revenue protection is an area-based revenue insurance product for dairy producers, and it's a protection against milk price, milk yield, and revenue declines. You get quarterly coverage, and the coverage is available for the 5 nearby quarters, so you can't cover anything out into the future past that. Livestock gross margin dairy and the DRP, only one can have endorsements in effect for the quarterly insurance period. So endorsements mean that you have insurance. So only one can have endorsements in effect for the quarterly period. Oh, let me see here. I think I'm not. Sorry, I got behind there. There we go. Okay. Sorry about that. So there are 2 pricing options for dairy revenue protection. Class price, which is a combination of class 3 and class 4 milk, and component combination of milk components. So that would include measures for butterfat, protein, and milk solids. And daily offers, the sales period ends at 9 o'clock each day. So most of the offers are done in the evening, but they have to be wrapped up when the market opens up the next day. So in the case of indemnities, you give notice of probable loss sent approximately 10 days after data for the quarter is released, and the producers must submit a claim form within 60 days of notice, and must also provide a milk production worksheet. Producers must market at least 85% of the declared covered milk production, and that's noted in the policy, as you see there. Dairy revenue protection participation did go down a little bit last year. These are pounds of milk, I believe. So there's been a little bit of a decline in 2023. We'll wait and see what happens for 2024. And with that, we'll jump over to livestock gross margin. This provides protection against the loss of gross margin, market value of livestock or milk, minus the feed costs on livestock. So that's the margin part of it. Applies to dairy, cattle, and swine. I'm most familiar with the cattle, and this is mostly used by the feedlot level of cattle producers. So it uses the Chicago Mercantile Exchange to establish the margins. Indemnity is the difference between the gross margin guarantee and the actual gross margin. And there are no head limits, and there are weekly offers available. LGM provides protection against the loss of gross margin on cattle, so market value of livestock minus the feeder cattle and feed cost. So that would be what would represent your margin. Subsidy is based on the dollar deductible that you choose. Deductible ranges from $0 to $150 in $10 increments, and the subsidy ranges from 18% up to 50%. And it's an 11-month insurance period. So each sales month, a producer can purchase coverage once per week. Producer selects target market months in which the cattle will be marketed. So your insurance will be the month that you plan to sell your cattle. At the end of the insurance period, the producer will submit a marketing report showing the number of actual cattle marketed and provide sales receipts along with the marketing report. The indemnity will be received if the actual total gross margin is less than the gross margin guarantee. So actual marketings must be at least 75% of the target market. There's been a big increase in livestock gross margin for cattle. This is by head, and you can see the big jump from years past. 2023 was at 448,319 head. And changes for 2024 for livestock gross margin, the ability to obtain insured signature up to 14 calendar days prior to the end of the sales period. And the procedure contained in the livestock gross margin, that's contained in the livestock gross margin handbook in paragraph 21D. Another change is the sales period end time. Cattle and swine sales end at 8:25. So most of those contracts are decided the evening before. You'd call your agent, let them know that you want to purchase the insurance, and you have to have all that wrapped up and signed by the following morning when the market opens up. So new terms and clarifications. Those are endorsements, premium billing for each endorsement. So that's billing per endorsement. And then on the LGM for dairy producers, it provides protection against the loss of gross margin on milk, market value of milk minus the feed cost. Subsidy is based on the dollar deductible that you choose. Deductibles range from $0 to $2 in 10-cent increments. And the subsidy ranges, again, 18 to 50%. And it's an 11-month insurance period. And so a producer can purchase coverage once per week. And continued dairy livestock gross margin, producer selects the target marketing months for which the milk will be sold, just like with the cattle. At the end of the insurance period, the producer will submit a marketing report showing the number of actual cut weight or 100-pound of milk marketed, and provide sales receipts along with the marketing report. In the case of an indemnity will be received if the actual total gross margin is less than the gross margin guarantee. And actual marketings must be at least 85% of cumulative marketings. Again, participation again for the livestock gross margin in dairy. It's gone up since 2020. Last year, we still had a down period in livestock gross margin for dairy producers. And then jumping over to livestock gross margin for swine, and that provides protection against the loss of gross margin on swine, as it does in dairy and cattle. The market value of swine minus the feed cost, that's what would represent the gross margin. Subsidy is based on the dollar deductible that you choose. Deductibles range for swine from $0 to $20 in $2 increments. And again, the subsidy range is 18 to 50%. And it's a 6-month insurance period. Each sales month, a producer can purchase coverage once per week. Again, producers select the marketing month for which the swine will be sold. At the end of the insurance period, the producer will submit a marketing report showing the number of swine marketed and provide a sales receipt along with the marketing report. In the case of an indemnity will be received if the actual total gross margin is less than the gross margin guarantee. And marketing must be at least 75% target market. They had a big increase in swine participation in the last few years, from 2020 to 2023. And that's good. We're seeing more participation in livestock gross margin. Jumping over to livestock risk protection, LRP. This protects producers against decline in the market price below a producer's selected coverage price. So it uses CME futures and option prices to determine the offer. Coverage should correspond to the time frame when livestock would normally be sold. So again, you're going to buy that insurance product for the month that, or the day is, well, in this case, it would be the contract month closest to when you're going to sell your livestock. And again, most of those are settled in the evening. Sales close at 8:25 a.m. to get ready for the market opening later that morning. So everything needs to be wrapped up by 8:25 in the morning. LRP, the premiums due at the end of the endorsement period, so producers don't have to worry about trying to come up with that premium payment while they still have the cattle. Once they get rid of the cattle, they can pay that and premium. And coverage is available for unborn livestock. Available for unborn calves, steers, heifers, Brahma, and dairy cattle. There are 2 weight ranges, the 100 to 599 pounds and the 600 to 1,000 pounds. Subsidies range from 35% to 55% based on the coverage level selected. Endorsement lengths, you can get 13 weeks. That's the shortest period you can get. So if you're wanting to insure cattle here for August, you'd be too late. So you would need to try to buy that 13 weeks prior to the August marketing time. So you can buy lengths all the way out to 52 weeks, which would be a year. And the head limits are 12,000 head per endorsement, 25,000 head annually. The indemnity is based on if the actual ending value is below the coverage price. Actual ending value is determined by the Chicago Mercantile Exchange Feeder Cattle Report Index. Price adjustment factors are below. So depending on what kind of cattle you have and what category you fall under, the price will be adjusted, excuse me. LRP for fed cattle, available for cattle expected to quality grade, select grade or higher, yield grade 1 through 3, and slaughter weights of 1,000 to 1,600 pounds. Subsidy ranges from 35% to 55% based on the coverage level selected. Again, same endorsement lengths for weeks. Head limits of 12,000 head per endorsement or 25,000 annually. The indemnity is based on if the actual ending value is below the coverage price on fed cattle. The actual ending value is determined by the AMS 5 area weekly weighted average district slaughter cattle report. The price series is the live basis sales. So steers over 80% choice category. LRP is also available for swine and unborn swine also, no type specified and no type specified. Target weights are from 189 to 351 pounds. Subsidies, again, 35 to 55%. Endorsement lengths are the same. Unborn swine for a minimum of 30 weeks and all other swine for a maximum of 30 weeks. Head limits 70,000 per head or head per endorsement or 750,000 head annually. The indemnity is based on if the actual ending value is below the coverage price. Actual ending value is determined by the AMS price series used to settle the lean hog future contracts of CME. Weighted average price calculated using the producer sold data in the negotiated and swine or pork market formula categories. So that's what you'll want to look for if you want to look that up. Here's the livestock reports page. You can get online and see this anytime for the prior day. And then in the evening, it's available for the current day. These are the coverage prices, LRP coverage prices, rates, and actual ending values. You'll pick your state, you'll pick the type of cattle, the weight of cattle you want, you'll look at the endorsement, the weeks, and the coverage level, and this will give you a price for what that'll cost you. And here's a link to that also. LRP participation has gone up big in swine in the last 3 years. More also has increased in feeder cattle, not quite to the same degree. And fed cattle, hasn't changed much from 2022 to 2023. Just a little bit now about the wean calf risk protection program. This is a new pilot program for 2024. It provides coverage to beef cow-calf producers from loss of revenue from their calving operation for calves up to weaning age. So this is an APH program, just like Angie talked about earlier. APH is based program utilizing the producer's own yield history and establishing their guarantees. So they're going to turn in the records that show what their history has been with their cattle herd. Plans of insurance are yield protection, revenue protection, and revenue protection with harvest price exclusion. Coverage levels are from 50 to 85%, and catastrophic coverage is available. We're required to insure all insurable calves, so you can't just insure some of your calves, you have to insure all of them. Insurance attaches at the time of submitting a calf report. So that looks like it was cut off there. Insurance ends at the earlier of weaning or the end of the insurance period, and spring types are based on when the calves are born. This is only available in 4 states right now for spring-born calves: South Dakota, Nebraska, Colorado, and Texas. Sometime in the future, it may expand. Who knows? We'll have to wait and see on that. Insurance availability. In accordance with the applicable standards contained in the United States Standards for Grades of Feeder Cattle, breeds or crossbreeds of cattle that would typically produce calves grading inferior, small frame, or number 3 or number 4 thickness grade are excluded and not insurable. So there are insurable breeds and not insurable breeds. Examples of uninsurable calves are the dairy breeds, miniature breeds, double muscle breeds, and some specialty breeds. All those breeds on the left in the black are insurable, and those are our most common types of beef cattle. So Just a timeline here, an example of spring calves. November 30th would be the contract change date. And then we'll have prices in December and January. Producers will make their decision, and sales closing will be 1/31. So they'll make their decision to buy insurance by then report their production in March by March 17th, have their final calf report by August, and then we'll have harvest price discovery in October, and the end of the insurance period is the next January. So that's the kind of the timeline that we would be looking at. Price discovery, again, that comes from CME. Here, these are the dates. Regional factors adjust futures prices to the region based on a 650-pound calf, and the base weight is 650 pounds. Do we have a map? Here's the cost estimator. I don't think we have a map of the regions. There are some pricing differences by region, but cost estimator link if you want to go and check that out. And then, of course, if you do need to have an agent, so you can use our agent lookup to find an agent in your area. And the last slide, if you have questions about the cattle programs, you can email rma.kc.livestock@usda.gov. And they are the subject matter experts on these cattle programs. So with that, I'll wrap it up. Thank you for your time, and I'll pass it on to our next speaker.
I don't think we have another speaker for today. I think it was just on risk management, and I thank you guys for participating. Do we have any questions? Comments, anything that you want to know today?
Is there some way to go back and see this online where it was recorded?
Yes, it will be. It'll be if you go to Colorado NRCS's website, it will be posted there online, and also it should be posted on FSA's website as well. We can send you the link since you're participating today, if that will help.
Okay, yeah, because the link I got to join online, it just kept saying bad link.
Okay.
And it would never let
Mine
me
as
join
well.
online.
Oh, that's great to know. Thank you.
So I didn't know if it was just me, but I didn't try. I never took it. I could see, at least not from the email I got.
All right, then that looks like that could be a problem. Thank you for letting us know. And I will definitely send an email out to all of you where the link will be. If there isn't anything else, I want to thank you guys for participating. And it's not something I normally keep up on, but it was very educational. So thank you guys for doing it. And until next time, next month, I will see you all later.